Creditworthiness is a non-issue, as we saw. Investors can therefore make profitable trades by correctly predicting the Fed's next move and inflation. Now let's talk about the yield curve in motion. Let's begin by seeing how the central bank affects the left-hand end. Imagine that the left-hand end of the yield curve were a jack and that the right-hand end were a hot air balloon. The left-hand end is set by the Fed's short-term interest rate decisions. It moves when the Fed changes the rate at the FOMC meeting. Let's take a look at how the federal funds target rate moves in tandem with the left-hand end of the yield curve in the 40 years since Nixon broke the link between the dollar and gold. Here is the number set by the FOMC over that period. Fed overnight interest rates are effectively the yield on a bond with a 24-hour maturity. And as we discussed earlier, short-term interest rates are a common way that central bankers around the world regulate the temperature of the porridge. Let's take a look at the Fed's target rate in 1989. It peaked then at 9.7%. If we now pull up the yield curve from 1989, we see that at that time, the short-term yield was 9.7%. In 1993, we see that the federal funds rate had been cut to 3%. Accordingly, if we pull up the yield curve from 1993, we see that the short-term yield was 3%. The Fed cut rates to close to zero at the end of 2008. Accordingly, if we pull up the yield curve from the end of 2008, we see that the short-term rate was close to 0%. Now you know that the left-hand end of the yield curve is simply the federal funds target rate. What about the right-hand end, the hot air balloon? This is less straightforward as there is no one single driver of the level of the 30-year yield on the far right. It is driven by beliefs in long-term economic prospects such as interest rates, GDP growth estimates, demographics, demand for borrowing, supply of lending. But one of the most powerful drivers of long-term yields is ingrained inflation expectations, as inflation is powerfully corrosive to bond prices. So, to summarize, the left-hand end of the yield curve is driven by short-term interest rates, and the right-hand end is strongly influenced by inflation expectations. Predicting how the yield curve will move is helped by two key indicators. As we saw earlier, Bloomberg allows you to view estimates of both short-term interest rates and inflation expectations on the WIRP and ILBE functions, respectively. So WIRP helps you predict the left-hand end, while ILBE helps you predict the right-hand end. When you think about it, guessing both ends of the yield curve boils down to guessing the gradient of the yield curve. Let's decipher what the gradient tells us about the bets and beliefs of bond investors. Bond traders make money by second-guessing macroeconomic trends and central bank moves. They sell bonds in anticipation of inflation rises and rate hikes. They buy bonds in anticipation of falls in inflation and rate cuts. So, for example, if rates are low and all of a sudden inflation goes up, the yield curve will steepen. Think of the yield curve, therefore, as a gigantic economic indicator, except this one is a little harder to read than the simple PMI gauge. The bets being placed on interest rates and inflation are apparent when the yield curve is obviously steep, flat, or inverted. Let's look at the yield curve from the 2003 Iraq War up to the crash of 2008. Let's begin on September 30, 2003, shortly after the start of the military action in Iraq. When investors anticipate a boom, inflation expectations rise and bond investors begin to expect rises in short-term interest rates. But remember how the shortest-term interest rates are tethered to the federal funds target rate, as shown here with the jack on both screens? They only change when the Fed finally gets around to changing rates. Meanwhile, the hot air balloon, which represents the yield at the long end, is set by unconstrained bond trading. Bond investors are free to express their views about future interest rates and get out ahead of the shifts in bond yields, which will happen when the Fed finally does change rates. The short end is trapped in the present, while the long end reflects future beliefs. This yield curve is from late 2003, when the recovery from the dot-com bust was underway, and consumers seemed unconcerned by the Iraq War. Bond investors sensed that the Fed might need to rein in inflation and preemptively lift short-term interest rates. With these expected hikes in short-term interest rates, new investors did not want to lose money by holding bonds. Bond investors, therefore, lifted the yields on the long end of the yield curve. Meanwhile, short-term interest rates had not yet been hiked, so the short end was anchored at a low point. This resulted in a very steep yield curve, a classic sign of an accelerating economy. The economy had gained a head of steam by 2006, and property prices soared. Fed Chair Ben Bernanke, as expected, had lifted short-term interest rates. The jack, therefore, rose. With economic conditions so good and with rates relatively high, many bond investors were positioning themselves for the aftermath, when the economy would slow and the Fed would cut rates. When the Fed cuts rates, yields go down and so bond prices go up. Therefore, investors were aggressively buying long-term bonds. This offset the natural upward slope of the yield curve and made it flat. As fears grew throughout 2006 that a downturn was on the way, Ben Bernanke indeed halted interest rate hikes. Bond investors, free to express their opinion on what Ben Bernanke would do next, were betting that he would cut rates. They therefore bought the medium and long-term bonds that would benefit from rate cuts. This thereby inverted the yield curve by the end of 2006. This is the financial equivalent of a bad omen. Remember, the natural order given inflation is for an upwardly sloping yield curve. An inverted yield curve therefore indicates that investors are brushing aside all inflation concerns and heavily buying long-term bonds in anticipation of rate cuts. The short end of the yield curve was trapped above 5%, hence the inversion. In this instance, these buyers of long-term bonds were spot on. Shortly thereafter, Ben Bernanke cut U.S. short-term interest rates from 5.25% in the summer of 2007 all the way to 0.25% in December 2008 as the financial crisis unfolded. The phrase credit crunch entered the public consciousness in the summer of 2007, a full 6 months after bond investors inverted the yield curve. The credit crunch became a crash in October 2008, which became the Great Recession in 2009. The bond market's dark prognosis, remember, came way back at the end of 2006. Yield curve inversion is incredibly telling. It is a powerful economic indicator in its own right of icebergs ahead, albeit one that required us to teach you all about fixed income before we could tell you about it. You can spot icebergs yourself by looking at the term premium, that is, the difference between 10-year government bond yields and 3-month government bond yields. When the term premium is negative, the yield curve is inverted. As of mid-2017, the U.S. yield curve had inverted 7 times since 1970. If we layer on the real GDP growth for this period, we can see that the economy had 6 pronounced dips, all preceded by yield curve inversions. The first oil crisis in the early 70s, the second oil crisis in the late 70s, the early 80s recession, the early 90s recession, the early 2000s dot-com bust, the late 2000s Great Recession. Note that the yield curve inversion in 1998 was the only false positive since 1970. It was triggered by the Russian government default. However, the dot-com boom helped to cushion the effect of the default on the world's financial markets. 6 out of 7. Pay attention the next time the U.S. yield curve inverts. The GC3D function is the GC function with a third axis added, time. This enables you to visualize how a yield curve has steepened and flattened through time. In this case, we have selected the U.S. government yield curve for a given 4-year period. Here you can see the x-axis of the yield curve, the y-axis of the yield curve, and the new z-axis. The colorful surface represents the values of the yield curve over this period. When the yield curve is viewed through this lens, relative steepness or flatness is apparent. The part of the curve with the red tips is steeper than the rest. The deflationary fears of mid-2016 are apparent with the pronounced green valley that year. Portfolio managers routinely check the GC3D function so as not to be caught off guard when the yield curve inverts. Think you've grasped these concepts? Answer these questions to check your understanding. To summarize, the left-hand end of the yield curve is simply set by the central bank, and so it only moves when the central bank changes interest rates. The right-hand end of the yield curve is set by bond traders' beliefs of future interest rates and inflation. While the left-hand end of the yield curve is locked, the right-hand end floats freely. This means that the gradient of the curve is rich with meaning. As the economy improves, bond traders think rates will go up to rein in inflation, and so they sell longer-term bonds in anticipation of price declines. Prices down, yields up, curve steepening. And vice versa. As the economy deteriorates, bond traders think rates will go down, so they buy longer-term bonds in anticipation of price increases. Prices up, yields down, curve flattening. If the economy is in really poor shape, bond traders may push the long end down so much that the curve becomes downwardly sloping, often an indicator of impending recession.